market's looking a bit more positive today, though we have come off our best levels, but we saw what came through yesterday afternoon, particularly the resources counters pushing our market higher, and that's continued through to today. Is this just a relief rally, or is there some other big force at play here?
I don't think really big forces at play here. Yes, certainly a bit of a relief rally, but I think the resources recovery yesterday afternoon came very much on the back of the strong bounce in the gold price. I think the risk averseness still emanating from the European debt crisis certainly has lifted the demand for safe haven assets, and that included the gold, but also the US Treasury. So we saw some movement into US safe haven assets, into gold, and that certainly assisted some of the commodity prices. We also had some reports out from some investment banks in the US regarding the outlook for growth and the outlook for commodity prices, and I think that just boosted the overall resources space. But it was relatively short-lived. You know, our own market already started declining from about 11 o'clock onwards this morning, and I think what probably weighs on it at the moment is that we are heading into a long weekend in the US. Monday is Memorial Day, so they've got a long weekend, and I think it's probably a little bit of early position squaring ahead of what will be big jobs data tomorrow in the US, and then ultimately a long weekend. So I think we've probably seen the best of the market for the next day or two.
Nerina, do you think we're going to continue to see these push and pull factors at play in our market? Because on the one hand, we do have negative news still emanating from Europe. We have that potential Greek debt restructuring. We're getting some positive comments coming out of companies like Goldman Sachs. You mentioned very bullish on commodity prices. We've seen that oil price up at $115 earlier today, copper back above $9,000. But it looks like there is a big push and pull factor at play here.
Very much so, and I think you know, as much as there's the sort of the pull factor in terms of expected growth that might be slightly lower out of China, there's now a better expectation again of growth out of the US. So it continues this push and pull and good news versus bad news. I think the overall scenario is still relatively negative. I think there's more concerns at the moment than there is good news at the moment, and when we do get the positive news flow, the market sometimes do react positively to it, but there's still an underlying tone of uncertainty and nervousness in the market. And I think until we actually get any sort of clear direction in terms of how this is going to play out, we'll probably continue to have this. I mean, we've got the QE2 in the US coming to an end in June, and this is now just a month away. So now the market pundits are starting to look at what will come after QE2 and how will the market sort of adjust to the removal of that, or is it indeed going to be removed, or will it be replaced with the QE3? So these are some of the issues that the market is trying to deal with at the moment.
And we also have uncertainty in the Eurozone at this stage, made worse by the fact that the IMF sits without a managing director at this stage, or without a real managing director. Lots of talk about who could take over at the IMF. The French would like their finance minister to be there, but it looks like the BRIC countries and developing countries are pushing for one of their own in that position. Do you think we're being too optimistic, thinking that Trevor Manuel could take over that slot?
I think it might be a bit optimistic to think that Trevor Manuel would take over the position. Not that he's not competent. I think he would make a great IMF chief. But I think there are many other candidates within the emerging market and developing market sphere that probably are stronger candidates at this stage. Certainly, Agustin Carstens from Mexico is being mooted as one of the strongest contenders in that space. I don't think this is entirely inappropriate for emerging markets to expect or to demand that the next IMF chief comes from somewhere outside Europe, because it was as long ago as 2007 that the IMF themselves and the Euro region themselves said that Dominique Strauss-Kahn would be the last European IMF chief. So this is an expectation that has been created over a long time, and I think certainly the sort of financial woes that have emanated from the European region just adds to the weight of the emerging market argument that says the next one definitely should come from at least a developing market, if not an emerging market.
What are the implications of having somebody from an emerging market at the helm of the IMF as opposed to somebody from developed markets? Because, of course, Europe has huge vested interests here, given the debt they owe to the IMF.
Absolutely. I think what you will find is probably a much better balance between the interests of the developed markets and the emerging markets in an organisation such as the IMF. So I think the implications would certainly be that at least it'll get more airspace, it'll get more attention in terms of whose voice should count for more and what sort of policies should be put in place, because there are a lot of people that argue that many of the policies that have been made have been developed market friendly and emerging market unfriendly. And I think that is potentially one of the biggest shifts that we could see, that there could be a more balanced approach emanating from the IMF if they actually have somebody in charge who is able to probably take a more global picture rather than just focusing on a former sort of G7, G8 type of picture.
Nerina, let's take a look at some of the news out here in South Africa today. We had results coming out from Mr. Price, and it looks like it's continued the startling growth that we have seen coming out of this group. Headline earnings per share up over 50% for the year, but it does warn that it's going to be difficult to kind of maintain that sort of momentum.
Yeah, I think once you reach this sort of high base, it is incredibly difficult to maintain that sort of momentum. I think certainly on the positive side with Mr. Price, when we saw some numbers from them in January, there was the expectation that we had seen the peak in their operating margins. Well, they've proven now that they were able to expand that even more, and it certainly wasn't the peak just yet. This is really on the back of very clever and very proactive management of their procurement strategy. They continuously look at where the best strategy or how the strategy can best be deployed, what impact that would have on duties and tariffs, what the currency scenario looks like, and I think that is probably the biggest contributing factor. It's quite a complex model, their whole operating margin, but it certainly worked very well for them. Another big announcement that they made today was that they are planning to expand into Africa and in particular into the Nigerian market as the first step. Now, I think the 300 million rand capex that they've earmarked for that certainly will result in the foreseeable future in some consolidation in their earnings. But I think for the long-term investor, it certainly paints a scenario of a company that will continue to grow. They're expanding into strongly growing consumer markets. And I think for the investor that is prepared to wait beyond the capex and look possibly to a reduction in their dividend cover, this certainly would still be a very good investment. On a shorter term basis, however, we think that the price is quite full and we'd prefer to rather be in for shinnies. It's certainly trading at a discount to both Mr. Price and Truworths, and we think at current levels it offers better value than Mr. Price.
And of course, we are expecting numbers out for Shini any time now. Standard Bank also out with an update today for the 4 months to the end of April, and of course that coming ahead of its annual general meeting today. It says that earnings for that 4-month period a little bit down on the same period last year, but it has seen some positive momentum from the end of last year.
Yes, I think they certainly have also got a relatively difficult base to operate from, but the trend continues to be against them, and the market is I think a little bit disappointed maybe with what's come out. It's not particularly negative, it is just a 4-month update, so it's not a formal set of results that we saw coming from them, but they've certainly highlighted that there are still many trends that are working against them, and probably of quite a big concern to them is that the biggest negative in this period under review came from the trading income side. Now, a trading income side is typically quite volatile and really the sort of area of business that can either cause you to shoot out the lights or cause you to underperform. And I think Standard Bank would love to see a more stable and annuity base to its income and not to be so dependent on the performance coming from areas such as the trading income. Not a particularly bad set of numbers, and we do see some weakness in Standard Bank's price today, but nothing to be concerned about.